Hello and welcome to the latest edition of the Tax Hour. I'm really pleased to be joined again by Sharon Cooke from 2020 Innovation, and today we're going to talk all about Legislation Day, which I say just had. It feels like it's actually been...
Yeah, it's been a while, hasn't it?
So, Legislation Day, let's get straight into it. What is Legislation Day? When was it? What's come out of it? We're going to talk all about that stuff.
Yep.
So, Legislation Day was on the 21st of July?
21st of July, yes. So this was the government giving us a bit of a preview as to what's going to be in the next finance bill, and therefore, what's going to be an ongoing conversation at the next budget, whenever that may be. So it's all part of the legislation creation schedule.
Yeah, I do feel like a bit like legislation. It's quite a complex road to get to having a finance act, which therefore leads into legislation. Because when you actually think about, you have a budget. So let's think about last budget. 30th of October, we had a budget.
Yep.
That is actually just all they're doing is announcing the finance bill that they drafted.
Yep.
Then that goes through 3 readings at least.
Yep.
In the House of Commons and then the House of Lords.
Yep,
something
sounds
like
right.
that. And then we finally, after all of that, end up with a Finance Act.
Yep.
Now, I know this is Legislation Day, and this is probably a bit historic for this, but I felt like that Finance Act took a long time to come out, considering, and I think maybe it was a part of, and we'll come on to this, the IHT announcements that we had, which never ended up in the Finance Act, which we finally do have some draft legislation for. So it is quite a long process to get to a Finance Act anyway.
It is.
And now we have a whole, it's not a new concept, but an extra concept of you have Legislation Day where we'll make some more announcements.
Yes.
Outside of a finance bill, which means there's no, speech that's televised as a big thing.
No, and in fact, I don't know if you saw, but they tucked all this. We knew the day was going to be 21st of July, and a number of us were refresh. And I think they released all the documents at like 5 to 5 in the afternoon.
Yeah, I was actually looking like when are they actually going to come through?
Yeah, it was. There's no speech, no moment. It's all part of the stagger, and of course that's then launched this period of technical consultation now, which is designed to give anybody that wants to opportunity to comment. We've got that running until 15th of September, and then I think we'll get the budget late October, probably early November, I think, and then like you say, it will be get the finance bill quite soon after that, and then we should then get the next Finance Act before the start of the next tax year.
Hopefully. You would hope.
That's the dream, isn't it? And then off we go again.
Yeah, because why I mentioned the previous budget was because I think the Finance Act finally came out very, very near to the spring statement. I was like, they've really got to get this Finance Act out before they end up doing another spring statement.
Yeah, it gets a bit of an overlap otherwise, doesn't it?
Yeah.
Yeah, absolutely.
Okay, so Legislation Day, I guess it's more about maybe a bit more transparency, that we can actually, see a bit more and actually talk about what's coming out. And because, I mean, again, I always come back to IHT because I've been doing quite a bit of talk about those changes.
Yes.
So, they announced some changes on the 30th of October 24.
Yes.
Then on the 21st of July 25, we finally have some legislation.
We get the draft legislation,
and then we've got a period of 6 to 8 weeks or something to actually discuss that, and then that'll go into a finance bill, and then we'll be back into going through the readings of the House of Lords and Commons. So there's still a way to go before we have that, but they don't normally change that much, do they?
No, well, I don't think with those inheritance tax proposals there's much wiggle room. I think that was made clear back in budget 2024 that we're telling you this, we're not consulting on whether to do it. We did have a consultation on the practical application within trusts, but, of course, here we're talking about the new £1 million threshold for 100% business relief and agricultural property relief, and the reduction in business relief from 100% to 50% on AIM shares and similar. And that was never a if, it was a we're doing this. So while there's been a bit of consultation around trusts, the Legislation Day draft legislation does include proposals that pretty much confirm everything that was said.
It was quite expected, really,
said
wasn't
last October. And I think, and perhaps we'll come to it later, I think a bigger piece might now be that probably isn't the end of the story.
No.
So like I've just said, we're gearing up now for another budget. And from what we're seeing, we have a government that for a whole host of reasons, including tariffs and their U-turn on welfare, they're going to need more tax revenue.
Yep.
And they've made these pledges to not tax working people. So income tax, national insurance, if we don't think about employers, and VAT are ring-fenced. So I think inheritance tax and CGT, there could still be more to go on them.
Yeah, we're moving a bit away from legislation day because I remember, but it's good talk. I remember when we were coming on the run-up to the last budget, not the last, well, yeah, I'm talking about the autumn budget, not the spring statement. There was obviously a huge amount of talk about CGT. And I actually had a slide from some webinars I was doing about, what percentage of tax is raised by these different taxes. Yeah. Obviously, income tax is a huge one.
Yeah.
And I've always said, okay, they might have made a pledge. Then they came in and said, actually, there's a huge hole that we weren't expecting and had no idea about. Would it not have been better, and this might be a bit controversial in itself, would it not have been better to go, okay, this is way worse than we thought. There's only so much we can do with things like CGT and IHT. Mm-hmm. But if we just increase, say, income tax across the board by 1%, it's not going to make a huge difference in most cases to a single individual, but it's going to raise a lot more than you could raise by increasing CGT or IHT. Because you can plan around CGT. The easy way to do is just go offshore and don't pay CGT. So you can do things like CGT is almost, it's not an optional tax, but you have more scope. I mean, you don't want to pay the tax, don't sell the asset.
Absolutely. You can control the timing of the transaction.
Yeah. So I've always thought, you know what? If you're open and honest and just say, look, this is a pledge that we are still committed to, but because of the level of the deficit that we've inherited, we're going to have some pain here. Mm-hmm. And even if we all take a tiny amount of pain of 1% compared to all of these other little bits and pieces that they ended up doing, would that not have solved the problem? I'm not political, but it does make me think,
there's the economics piece, the political piece, and they're already planning for the next election, aren't they? And there's a voter pleasing piece here, and a lot of the voting public are very interested in wealth taxes and seeing those earning a lot pay more, and perhaps a 1% increase across the board would be a difficult pill to.
Yeah, I was going to say it's more the visuals of doing that and having made the promises you made and things like that. But
I agree, they've got to go further with CGT and IHT to get the level of tax they're looking to generate.
Yeah. Okay, let's bring it back into legislation day. So legislation day typically is about announcing draft legislation, any new consultations. Yeah. So as far as I can make out, we've only got one new consultation.
Yeah, that was an interesting observation. I hadn't actually done a count as such because we had a lot of responses to consultations on legislation day. But I think what that ties into is at an earlier announcement, the Chancellor had said that they acknowledge that for advisors and professional bodies and for those that traditionally comment on consultations, to release a whole tranche of them at one go, they accept that creates a lot of work in one go. So they had mentioned about staggering consultations over a longer period of time. And I wonder if that's why we only had the one. Yeah. But that also then makes me think, when we go back to our computers this afternoon, is there going to be
suddenly going to be a new one
that we're just going to have consultations turning up? So we're in a new routine with consultations, I think.
Yeah, and that does make sense because having been involved in a few like EOT responses and things like that, it's not a 5-minute job for either. Anyone can respond to consultation. So whether it's you as a firm with just an interest in that tax, or as part of a wider group, and I think the wider group ones, so like CIOT and ICAW respond. So there's a group of people committed to assisting with that consultation response, and it does take time to.
It absolutely does. I used to sit on the London Society of Chartered Accountants Tax Committee, and we would respond to consultations. So you have a group discussion, and then somebody would go away and write something up, then back to the group, more debate, try again, back to the group, try again. So it's a huge investment in time just for one consultation. But I think equally a really important piece, and I was actually talking to a firm last week that made a good point about legislation day, that we're into this period of technical consultation.
Yep.
And I think it's very easy to look at the draft legislation that's come out and kind of go, oh, okay, that's the direction of travel. But we mustn't lose sight of the fact that if there's anything we or our clients feel strongly about that is being proposed, we have got the period from now until 15th September to go, hey, I've got some thoughts on this.
Yep.
And in the legislation day pack, with every tax information note, at the end of it, there is an email address from somebody within HMRC that anyone can contact to go, I have some thoughts on this.
So I think it's good. Well, the more consultation responses and the more, that if they get the same response from many, many people, obviously, if you have a group like the ICAW or CIOT or ATT, I don't want to leave people out, so I'm trying to name a few more.
Well, name them all.
So, those bodies hold a bit of weight, I think. But, the more responses they get, it can only be a good thing. And hopefully, I think HMRC do listen and consider them. I'm not saying they always actually act on them, but
no, there's quite often where you'll get the responses document. They go, "We've listened to the responses. We're going to carry on as planned," and that's their gift, I guess. But there are also cases, and actually back to inheritance tax, they had been consulting on how it would work within pension schemes, with bringing pensions into inheritance tax from April 27.
Yeah.
And one of the news pieces from legislation day was that the government had been proposing that pension scheme administrators would deal with the tax liability. And following the period of consultation, that will now go back into the executors of the state to deal with those.
Which I think was a huge relief in most cases.
Huge relief for one camp, not such good news for the other camp. So there's always a double-edged sword in there. But that is, I think, a good example of where consultations do make a difference, and they do change the journey. It's just, I suppose, a shame that there's so much that happens where there isn't consultation.
Yeah.
And I know, well, particularly around the agricultural property relief, there's a lot of views within the profession and within the farming community that it could be achieved in a better way, in a fairer way, in a more proportionate way to the way in which farms pass through generations. And consultation maybe could have actually brought some better ideas to the table. But that opportunity was just never given.
Yeah, I do also think it's good to have consultations. It's because if you're a HMRC body, you don't necessarily know what the views of the individuals directly impacted by things like this are. So, that's a good thing. But at the same time, there's also got to be a level of control where HMRC say, well, this is the tax system. We have to, not everybody's going to like it. We can't please everybody. So at some point we just have to say, look, this is what we're doing. And again, it comes back to the wider, it's economic, it's political. And I don't personally think it should be political, but it should at least be economic and all the rest of it. So, okay. So consultations, the only one we had was around land remediation relief. So not a
high hitter within general practice, I find. No.
I think that's quite a niche area, so we'll see if. I think the main points were about whether or not the relief is still worth having. Is it still viable? Is it still achieving what it was intended to achieve? And is it open to abuse? So kind of quite a typical type of consultation, really, for a relief, I think.
Yeah, I'm sure there's a purpose behind it, so I would think change is afoot. Yes.
So I don't really think we need to go into too many.
No, I would think
we'll
that
be
the draft
on here for hours,
legislation is probably a bigger piece.
So draft legislation, we have anybody, as we said, has until the 15th of September to respond to it.
Yes.
Where should we go to first? Should we talk about IHT because we keep talking about it?
Let's talk about.
Otherwise, we'll just keep coming back to it again.
Yeah,
we'll talk about it.
Let's get the inheritance tax off our chests. Yes.
Okay, so I mean, for me, the big one, obviously, been in corporate tax and dealing with owner-managed businesses almost entirely. The big one was around business relief.
Yep.
But this extends just as much to agricultural property relief.
Yep.
Should we briefly explain business relief before we actually start talking about all the changes? So inheritance tax before, if you qualify for business relief, which in the context of owner-managed businesses meant you own shares, especially if it's a family company or a trading company.
Yep.
If it's a trading company and it's an unlisted company, you get 100% relief.
Yep. And unlimited.
And unlimited, that's the key fact.
Yes. And for lifetime and death.
Yeah.
Which gives maximum flexibility.
Yeah. So any gifts in your lifetime, if they're subject to a chargeable lifetime transfer,
Yep.
fully relieved.
Yes.
And still fully relieved until the new thing. So people are, considering the changes, people are looking at planning before those changes come in. So that's kind of, in my world, that's the big one. We've also got agricultural property relief,
Yes.
basically for farmers or farm owners.
Yeah.
And it was a very similar concept, wasn't it? Unlimited relief.
Yes, and more of it was 100% with agricultural property relief as well as business relief. We've had a mix of, and still will have a mix of 100% and 50%.
50%, yeah.
Reliefs from inheritance tax. So very valuable reliefs to business owners, farming and otherwise, to enable those businesses to pass between generations and recognising that there's not necessarily, particularly within farming businesses, liquid assets in those, and to take 40% of any taxable value out, it's, that is going to be a lot for ongoing generations to finance. And well, one of the things coming out of legislation day to try and help with that point is it has now been confirmed that for all agricultural and business relief eligible assets, there will be the ability to pay an inheritance tax over 10 years.
Yep.
But still, that money has got to come.
It's still a lot of money in most cases, I think. So my bugbear really was, and it was because it came out of, we were in the middle of doing some work for a client who didn't qualify for business relief. This was around the October budget. They actually had a property portfolio, so it was completely within the scope of IHT. But the problem that they had was that they had this property portfolio which was worth about £12 million in a company. Mum and dad had died, handed down to the 3 children and their families.
Yeah.
And now they're saying, well, £12 million is fully exposed at 40%. They also had a house which they were struggling to sell, which was worth a lot of money but couldn't sell. So where are we going to get 40% of 12 million from? One of the children wanted to carry it on. The other 2 had no interest and just wanted to sell out. So what it ended up being, if that's an ongoing business, if the one person wants to carry on, if you assume the share buyback rules didn't qualify, because obviously that needs a trading company as well, otherwise it'd be income. So you ended up with a position where you need 40% IHT to pay. The only way to get this money was to sell the properties in the company, which means 25% corporation tax. Yep. And then, if one of the guys is going to carry on, the other 2 need to be paid a dividend.
Yep.
So you've ended up with 40% IHT, 25% corporation tax, 39.35% dividend tax. So the effective rate of tax is 80 plus.
Yep.
And in a sense, it's like, okay, well, it's property investments. I mean, we were looking at planning as, can this be ensured to be a capital, and looking at demergers and MBO type structures. But in their case, it's okay, if you haven't got the money, sell the properties and you'll have the money. For a trading business, they don't necessarily have something they can sell. Or how do we get, and it's not unusual for trading businesses now to be sort of 5-10 million, even fairly small ones are worth that kind of money. Or go out to a bank and say, we need to pay an inheritance tax bill, so we need to either personally get a loan and take security over the shares, or the company does. In which case, you've got huge cash flow problems for the company now having to repay loan payments. And that, to me, is the biggest impact, when the whole idea of, the government's pushed a lot about growth in the economy. How is and the same principle, I guess, applies to the farmers with agricultural property relief. How do you, if you are now burdened by a huge debt, whether it's IHT, whether it's a bank loan that you've now got to pay the IHT, whatever it is, how do you grow your business if
Yeah.
As you say, you've got 10 years to pay the IHT now. So over the next 10 years, you're basically funding IHT instead.
Yeah.
I'm
starting to worry about the next generation. I think this isn't a one-off problem either, is it? I think it's a real challenge. And a lot of the firms that I've been working with, talking to on our webinar program, we've been talking a lot about inheritance tax planning to try to. So I think we're just going to have to do more and more in advance to try and manage those estate values, to therefore manage the liability coming out of the estate.
Yeah, I just want someone to tell me the economic purpose of this and whether it actually. I genuinely can't see how this is, because when they released this, they did have. I'll have to dig out the link, but their standard comments on it, and in terms of how much they expect it to raise.
Yeah.
And I think the first year it's around $250 million.
Yeah, I think.
And then
have you got it? I have those stats.
There you go.
There we are. See, you invite me on for a reason. So the revenue are estimating that 2,000 estates will be affected initially in 26-27, generating £230 million.
Okay.
And thereafter, they're estimating it will generate £500 million of tax a year.
Right.
So a substantial measure. But what I would say, and again, this really comes out in worked examples, is the agricultural property relief, business relief, restrictions on the 100%. I don't know, we've actually said there'll be a new £1 million per limit.
Yep.
Limit per person of how much 100% combined agricultural and business relief we can have. Thereafter, the relief's dropped to 50%.
Yep.
That is absolutely having a hit on larger business and agricultural type estates, but of a much bigger significant for tax take and cost for individual taxpayers is what's coming in April 27. So the agricultural and business changes of April 26.
Yep.
Deaths on or after 6th of April 26. And then from April 27, we're going to see unused pension funds coming into estates. And my goodness, when you see worked examples, I was actually reviewing a inheritance tax planning letter for one of our member firms last week, and they've done worked examples for one of their clients, and here's the inheritance tax liability you'd have today.
Yep.
Your estate would have today, then next year, and then the year after, and the pensions. I guess it all depends on values, but bringing that in from not in the estate at all to fully in at 40%, that's having a bigger impact than a 100% relief dropping to a 50% relief. So pensions are potentially a bigger issue.
Yeah, so we're going to get $250 million, then $500 million. How much do we trust that figure? I don't know where that figure comes from. So I'm thinking, fine, maybe if all of the companies of that certain size are now going to pay IHT on the death, that's what you'll get. You're estimating 2,000 estates coming into it. But what about the clients who are now coming to me going, I'm not really sure it's worth carrying on?
Absolutely. And in the impact assessment itself, it does say these figures are estimated because even the government are saying we don't know what planning people will do.
That's why you need an economist.
And again, jumping ahead, I mentioned it earlier to the next budget, it's beginning to look as though we're going to see more. And something that's been a key planning piece, I think, for these upcoming inheritance tax changes is, right, let's look at lifetime gifting. I think I mentioned that before. And something I've been asked to cover on training courses quite a bit this year is the relief for normal expenditure out of income, which is amazingly generous.
So at the moment, if you have excess income...
Yes.
Now, again, I'm not an IHT person, so you need to help me out here. But basically, if any income in excess of funding your personal living expenses can be gifted each year, and no IHT is paid, and it doesn't come back into your estate on death either. No,
so it goes. It doesn't even have to be each year. So if we've got a regular pattern, and we can show an intention to make it regular, it enables individuals to make gifts well above the 3,000 annual exemption and well above the marriage gift limits, for example, because there is no limit to normal expenditure of income. So it enables people to do things like quite common is like paying grandchildren's school fees, which have got a lot more expensive because of the VAT changes in some cases, it's full circle. So something like that is just a nice way to do it because you can show the ongoing the ongoing commitment. So normal expenditure out of income could be a key planning piece to where we've got liquid assets again, though, and we've got this surplus income, which I understand farmers don't feel they really have, but for some estates, that's there as a really good, I think, planning tool. Also, potentially, just generally doing gifting before April 26 could be good, but it's not as simple as it may seem, because even if we're gifting before April 26, if the individual dies within 7 years of that gift and their death is after April 26, that 1 million limit might come chasing.
I think our
anyway.
private client team have been talking to people about so gifting, and then your 7-year rule is if you gift to family members and it's a pet, a potentially exempt transfer. There's an alternative planning where you gift into trust.
Yes.
But then obviously you've got to be careful, because then you have 10-year charges as well, don't you? So
absolutely. And the 1 million limit rule is going into trusts as well.
Yeah.
So trusts might be part of the solution, but they're not going to be they're not going to remove the problem altogether.
No.
So there's been a lot of talk, and there's, like I mentioned earlier, there's a lot of planning going on in practice at the moment. But if we're seeing the government taking another look at inheritance tax now, I would think they're going to be looking at exactly this planning that's happening to try to get value out of estates so that we can gift business and agricultural property within the 1 million limits, and the value of pensions coming into estates is perhaps less from April 27 because we're pulling it out of the pension sooner. I think lifetime gifting
is at risk.
I think we could see more coming in the budget.
Okay.
And that, again, creates a bit of a planning problem,
It
doesn't it? I spent the first half of this year talking about what we're expecting to happen with inheritance tax. We're going, it's just a bit difficult to do planning without draft legislation. Now we've got the draft legislation. And I think I'm going to start saying, it's just really difficult to do the planning because we don't know what's going to be said at the budget.
Yeah.
But I think we are a million miles away from them backtracking at the budget. I don't think we're going in that direction.
Yeah, I don't. As much as I'd like them to, I can't see it happening.
So
you think that's where your you think there is going to be more IHT changes, but it's going to be around ensuring that the planning that you and I might come up with is not going to be effective.
I think on a big scale.
Yeah.
So I would imagine, but I mean, I am speculating. I do not sit in that. I do not sit in that room. I would imagine normal expenditure out of income, you'd hope for things like school fees would still carry on, but individuals with a lot of excess income making ongoing excess gifts, they might find that is curtailed, but we will.
Okay.
We will see.
One sort of planning thing that I'd come up with again before the draft legislation, so it was always a bit of a sceptical, is this going to either be needed, because I still had hope of backtracking, but
a lot did.
But it was the idea of implementing sort of a growth and freezer share structure into your company. So if you've got a trading company, the first problem is, and we haven't mentioned this, I don't think, this £1 million is per individual, so it's not transferred to a spouse.
No, it's a real shame.
Which is, I think, quite painful, because a lot of wills will just say, we'll transfer everything to the spouse.
Yep.
And then on the second death, the spouse hands it down to the children, whoever it might be.
Yeah, I think that will change, but that's what a lot of them say at the moment.
So at the moment, if you have a will that does that, you only have a £1 million business relief.
Yes.
At the 100% threshold. Yep. Whereas if you say, well, actually, we'll change the will slightly, so the first £1 million worth of shares goes down to the children to make sure that the first death uses their full £1 million limit, and then on the second death, the spouse still has the rest of the shares to hand down. So that was a part of it. And then the other part of the plan was any growth from today will having as a growth share to the children who you're going to hand them down to anyway in the longer term. Yeah. So it that kind of planning basically just says it helps with the IHT. It doesn't get rid of IHT, but as a bare minimum, it gets any future growth outside of your IHT estate. Yeah. Which I think is a fairly tidy way of doing it.
Yeah, and I think that's still going to be a very valid plan.
I can't imagine them doing enough to attack that type of thing, because it's genuine commercial planning as well.
Yes, absolutely. Yeah, no, I think that's a fair shout.
Yeah, but definitely the income, the excess income seems like a fairly easy target, doesn't it?
It almost feels too generous, doesn't it? There's a few things in the tax legislation where you think, wow.
It's just whether you have that excess income in the first place, really, isn't it? That's where it really comes down to.
And we mentioned wealth taxes earlier, and the government it does seem to come up quite a lot, and there's pressure on them. And I don't think they're going to implement a wealth tax as such. But I can imagine in the budget we're going to see positioning around inheritance taxes and capital taxes as being something as close to that as we're going to get. So I think potentially limits on lifetime gifting could be on the agenda. And what we were expecting last time around, and it didn't happen, was an extension of the time frame for potentially exempt transfers. So at the moment, if a gift is made and the donor lives for 7 years beyond that, it becomes exempt for inheritance tax. And we've got this 7-year rule. And I do wonder if we're back to thinking, should that be 10 years, for example, so the gifts stay in the net for longer.
Oh, that would be painful again.
Yeah.
Because you already think 7 years is quite a long time. By the time you're looking at inheritance tax planning, I mean, some people are good and actually come early enough that you can make these changes. But a lot of people might already be thinking, something might have triggered them to think, I need to think about IHT because they've had a health scare, or because they've suddenly got to, they're now in their 80s and thinking, how much longer kind of thing. So 7 years in a lot of cases is already...
It is long. And I think we're going to see, or just have to have behaviour changes around inheritance tax. And one of the things we might see the government or the revenue look to do is to bring in more in the way of requirements of annual gift registers, because that point, once somebody has died, we can't ask them. So for the individuals dealing with their estate to work out what they've gifted, why is it exempt for the last 10 years? And for normal expenditure out of income, we need to show what income and expenses are as well. So we need a whole host of records that are not necessarily maintained.
Yeah. Especially if you're quite wealthy and you've got lots of sources of income and
transactions all over the place. And we should obviously have income nailed down because that's going on the tax returns.
Yeah.
But what they're spending in their day-to-day lives, so what they're spending on holidays, household living, that isn't data we've necessarily got or anybody's got. But yet we need it for normal expenditure of income. So I do wonder if we will need or see a requirement for maintaining that on an ongoing basis in readiness for estate paperwork. A bit like making tax digital. I'm not starting a whole new agreement now. We're making inheritance tax digital, but live, real-time records. I do wonder if that could be a direction.
I mean, if nothing else, it's about helping the executors of the estate more than HMRC, arguably.
Yeah.
And I do know people who kind of do say, look, this is that whatever plan they come up with is, to help, because they're not going to be here kind of thing to do that. So,
I think it could be good practice to get, some firms are doing it anyway.
Yeah.
But I think if we look, I think it's the IHT 403 is the gifting one. Right. And there's lots of schedules on that you need if you're gifting, including the gift register itself, but also for the 7 years at the moment before death, the summaries of annual income and personal expenditure. I think it'll be interesting to see if we see practices do more around, let's get that done at the time we're doing your personal tax every year.
Okay, that's interesting because I hadn't thought about that. So that's good. Okay, so I think we've probably covered enough about APR, BPR as we
put it down now, you think?
Let's put it down for a minute.
Okay.
As much as it's become a bit of a passion project. Yeah. We've covered pensions as well, so I think that's most of the IHT. Should we talk about making tax digital as you just brought it up briefly?
Yeah, let's talk about it. So again, despite I think perhaps some hope to the contrary, we didn't on legislation day see the government going, you know what, we're going to stop this. No, far from it. So we did have some news on MTD on legislation day, nothing earth-shattering that hadn't been announced before in the main. We did learn a new term of latency And I think a lot of us were going, what's this?
That's exactly my reaction.
Let's just get the direct dictionary out. What's latency? So they were talking about that. And actually, it's a pretty simple rule that if we've got, I think the example we've been using is if we've got somebody that's been brought into the Making Tax Digital regime, let's say they've got property income of more than £50,000 a year in 24-25, that means they will have to go into Making Tax Digital from April 26.
Okay.
At that point, digital record keeping, quarterly updates, and a whole brand new year-end process. So this latency rule that HMRC were talking about on legislation day is saying when somebody's already in Making Tax Digital, what if they have a new Making Tax Digital qualifying income stream? So they start trading. At what point does that trade, so that individual's already in Making Tax Digital, at what point does the trade have to be reported, have to have digital records and have to go into quarterly reporting? And the answer to that is we look at the tax year of commencement. It's one of these riddles.
Okay. I'm already scared.
Right,
What's coming up?
So we look at the tax year of commencement, step one.
Yeah.
Then we look at the normal self-assessment filing deadline for that first tax year of, let's say, a new trade income. And then we look at the 6th of April after that filing deadline.
Okay.
And that 6th of April is the start date that new MTD qualifying income stream has to come in. That, Nick, is latency. Now, of course, in reality, that might not be practical. It might be, we're already doing this. We've already got functional compatible software. We've already got a system. We've already got a process. So we might bring new trade
straight in
on a voluntary basis, but would only be required to bring it in from that 6th of April after the filing deadline for the year the trade commences. It's just ongoing, ongoing good stuff, isn't it?
Yeah.
But yeah, lots of questions still around Making Tax Digital, and I think it's a challenge. And we'll come on to something else actually from legislation day in a moment. But Making Tax Digital is a great example of where we still do not have the full picture. And yet that start date is getting ever, ever closer. And I think it's really, really hard for practices to double down and say, this is what we're going to do, because we still don't really know everything. And some of the really important pieces around year end that will change how we interact and our approval processes and our engagement letters with sole trader clients and landlord clients. This is really important while carrying on doing what we're doing now for anybody who's hasn't got sole trade or rental income. So if somebody is just a partner in a partnership and they've got savings income, self-assessment continues as now. So everything remains as now, but we've got new processes. So how a tax return is approved and when is going to look different for sole traders and landlords, in that HMRC are likely to have information and do a computation potentially before the client has given the nod to say, yes, this information is true and correct. And because we don't have that information at the moment, we've seen the professional bodies put out specific guidance under professional conduct into relation to taxation, so the way agents need to behave around quarterly submissions in particular, because there's some excellent planning going on with quarterly submissions. It's with the professional bodies going, let's just remember our fundamental principles. And we've also seen a draft engagement letter, because the way we do it, we're not doing one self-assessment after the end of the tax year anymore. It's a whole new world for a segment, but not all of clients. And we don't know what that looks like in August 2025 for an April 26 start date.
That's pretty scary, actually, isn't it?
I know HMRC are working a million miles an hour, and they've got a great team that have, and credit to them on this actually, they have invested time with businesses and agents to listen, to explain. They are trying their absolute best. They are running a million miles an hour, without doubt. So this isn't me criticising that team by any means. It's just the reality that because we haven't got this information, all of the information, it's difficult, I think, for firms to say internally or to their clients, this is what we're going to do.
Yeah.
So I am seeing, we work with 1,000 plus firms of accountants at 2020, and I'm seeing a range of behaviours from nothing. That's still quite a popular approach. Looking forward to that next February, and I think it will be next February.
Yeah.
We are doing proactive communication with clients, and what I really like to see is when we're sending out 24, 25 returns for approval, putting something in that cover letter or cover email to say, based on your income that we've just reported for 24, 25, you are going to be mandated into this regime from April 26, if of course that is the case. Here's perhaps the link to some more information about it. But then what's usually being said through necessity is, as a firm, we are currently considering our position and how we can best help you with this. Please await further instructions. Kind regards. And I get that, because the software companies, they're still developing, particularly around year end. There's been a lot of testing of the quarterlies,
right?
But that year end piece, we're not there yet.
Right.
Sorry, it's very long. You asked me what happened on legislation day. I was like, let me have a therapy session.
MTD is a bit of a pet project of yours, though, as well.
Yeah, well, I haven't actually been leading on it within 2020. I'm very fortunate to have a team, and Emma in our team has been doing a lot of it. But I do, because we get so many coming onto any webinar when we're talking about making tax digital, I tend to hop on as well to help in the Q&A, very much like I do on yours, Nick, except I can't answer your questions. I have to go, Nick, stop talking. I'll need to read it out for you. Whereas I could just do the chat on the MTD ones. So we get a lot of huge numbers, huge amount of questions, and some of those we can answer. And there is still that learning piece going on, absolutely. But it's going to be, I think, really interesting, let's use that word, to see the impact this is going to have on practices and businesses, the people that are actually running the sole trades, and especially the landlords, to do quarterly reporting as a landlord when you're nowhere close to that at the moment. This is a big change that I guess you're only ready sometimes when you've got to be.
I mean, do you think those accountants who've gone into is it called the beta or what?
The pilot, the testing.
The pilot testing. Do you think they're going to be in a much better position to when this finally hits, or do you think they're just helping iron out the problems and?
It's, again, like we were talking about earlier. There's a whole range of considerations. I think if we think about the firm, probably they will be. I think it'd be difficult to suggest they wouldn't be, just because they've got more visibility. So when they're considering what they want their engagement terms with their clients to be, what they want their pricing structures to be, how they want to work with the clients in terms of where the handover is, so who's doing what, the software choices they've got, the more information anybody's got, the better decisions they can make.
Yeah, absolutely.
So that's good for them. But is it good for the clients to put them in the beta? And I think that is the challenge. So by signing a client, only certain clients can be put into the testing program anyway. So they've got to be eligible. Once a client has been put into the testing program, they're moving from the old revenue system onto the new revenue system. And that, as part of that also means the way in which late filing penalties work changes. We're going from the old penalty regime to the new penalty regime, which is the points win penalties regime.
Okay.
And actually the penalty regime, while there won't be any late filing penalties for the quarterly submissions while testing, the penalty regime can be more severe at year end.
Okay.
So there is a bit of a question as to whether it's best for the client from a penalty perspective, from a professional fees cost perspective, from a software cost perspective. Is it in their best interest to put them in this process now? And of course, we're all testing a process for HMRC. And there's a big viewpoint out there that, we'll join, we'll get involved, but we're not up for being a guinea pig. This doesn't commercially work for us.
Well, exactly, yeah.
So when it's certain, and we can give our clients certainty, we're there.
Yeah, I was going to say that most firms, I don't think, and most accountants are always busy and things. they probably don't really feel like, oh, we've got the time to be the guinea pig.
No. I mean, good. I mean, for those that are doing it, good for you. And I get it. And you've definitely got really, really good intelligence. So it's good for the firm. And I think you've also got some really good clients that have gone, I'd love to support this initiative. But even those practitioners that are keen and want to get involved, even they report they've had clients that are going, thanks, but no thanks. Thanks for the offer. I will politely decline to do quarterly submissions on a voluntary basis. It's a big shift change for the accountancy profession. And I think, like I said earlier, it's going to be a bit odd as well in that we're taking our self-assessment population and splitting it into, and there'll be two separate sets of procedures depending on whether that individual has MTD qualifying income. So as soon as they've got any MTD qualifying income, all of their income is going to be reported via functional compatible software. If they don't have trade or property income above the income thresholds, or they're excluded, then they'll stay on the current self-assessment system for now.
Okay. So the other thing that came out, and I don't think we've mentioned this, is corporation tax is officially out.
Yeah, not the tax.
No. That was a bit of a grand statement.
That would have been a bigger headline. Yes, so it has been confirmed that MTD for corporation tax is not on that roadmap. I would go back in time a little to last autumn. You mentioned budget last year on 30th of October. At that time, we did get a corporate tax roadmap, and that was talking about a new digital basis for corporation tax, which didn't sound or look like MTD. And I don't think it will include a quarterly element. So things will change for corporation tax. When and what, we don't know. But any ambition to put companies on a quarterly submission, that appears to be by the by. Partnerships, however, still on the roadmap, but not with a when. HMRC seem to be saying they want the sole traders and the landlords in, stable, working before they even start thinking about partnerships and partners of partnerships doing quarterly.
Okay. So progress is being made.
Yeah,
slowly.
We see a lot of news, a lot of change. So I do a monthly tax update, and there's usually something in there on making tax digital. It's again, I said like HMRC, they're working a million miles an hour, and that means guidance is being updated quite regularly. We're seeing new regulations, changes happening.
And we shall see what happens in April. I'm just glad I'm not involved in this stuff. Okay, so what else have we got in legislation day? We've got a little bit for employers in terms of company cars and things, but nothing that I saw as particularly drastic.
No, I wouldn't say they were mainstream changes. No. They were things that I've put further down the list in my. I mean, one of them was really quite speculative, talking about a possible future change to, was it plug-in hybrids?
Yeah, that's right.
Was mentioned, but it's talking about how in the UK we might categorise vehicles differently and the impact that would have on benefits in kind.
So nothing we need to be getting too
probably
worried about.
Probably not a headline. One of the bits that I think is really significant and potentially could be, and it's back to something I mentioned earlier, where we've got an April 26th start date, but we haven't got all the information. And this goes back to the consultation that's been running for some time now about, and the name of the consultation has just dropped out of my head, but about tax advisors and conduct of tax advisors.
Yes. Yeah.
And we've had a lot around that as to whether there should be a new regulatory body, whether HMRC should regulate all tax advisors. And there was a point when there was going to be mandatory PI and professional indemnity insurance, and then that U-turned. Where the last round of consultation got to was that there was broad support that anybody engaging with a client or helping prepare documents that HMRC relies on, if that person is acting in a business, person being a business as well, if that person in tax world is engaged doing that work as a business, as part of their business activity, that tax advisor, which let's think about a firm at this stage, that tax advisor, that firm would need to register with HMRC. Now, when this was first mooted and said, we're going to do that, it's going to be the case from April 26, may have just been me, but in my head I was thinking, well, if a firm has already got their agent services account, well, they're registered. What's come out on legislation day are these tax advisor registration requirements. Right. So we now have draft legislation and we have the tax information note around it, but we haven't got guidance yet. But it is uncertain whether literally all tax agents are going to need to register. And I think that is what they're saying. And that, if that is what they're saying, that is quite a big step. So they're suggesting April 26th start date. So all agents, so all firms in our world that engage with HMRC would need to register by April 26th with a 3-month sort of transition or phasing in period, which isn't very long. And that would involve, so for a sole practitioner, relatively simple, because they and the firm are one and the same. That individual would only be able to register if their own tax affairs are up to date, if they've registered for AML, anti-money laundering, if they've got a supervisory body, fine. But if, as soon as we get into 2 partners plus, whether that's a partnership, an LLP, or operating as a company, we've then got to identify senior managers. And senior managers broadly were saying it's anyone who is in a company, in a corporate firm, it's anyone who is a director or is acting as a director. In a LLP, it's anyone who is a member or is acting as a member. In a partnership, it's anyone who is a partner or is acting as a partner. Now, that phrase we're going to need more on, but the synergies there, I would suggest, with practicing certificates that we have with professional body requirements, that you might not be an actual partner in a partnership, but sometimes you need a practicing certificate because you're held out as. Different language being used in the 2 rules, but I would think they're going to come out broadly similar. And then for that firm, so let's imagine a firm of accountants that's got 10, 15, 20 partners. What we're saying is then for April 26, they would need to register the firm, name all of the senior managers, and confirm that the eligibility requirements have been met for all the senior managers as well.
Right.
Now, let's say that one of the partners has got behind with their tax affairs. What are we saying here? The whole firm can't register to be an agent with HMRC?
That's drastic.
Well, isn't it? So this hasn't been getting a lot of airtime so far, but this is potentially...
I mean, when you said at April 26, that's very little time to actually publicise this and make this happen.
Yeah, and again, it's HMRC will be publishing guidance in due course.
Thanks.
So there are uncertainties at the moment. Like that question, what if one partner has got behind with their tax affairs? I mean, it might even be somebody isn't working in tax. It could be, the corporate finance partner. So again, and it's that unfortunate April 26 date, isn't it? There could be a bit of due diligence that firms need to do internally to get themselves ready for this. But key is we really need to bottom out how it links with existing agent service account registrations. It's beginning to look as though irrelevant, because of course that doesn't involve listing senior managers.
No. Well, it's interesting because if I look at our firm, so obviously we're part of a wider group, but Jerem's Miller pretty much does reconstructions. We don't really do much with HMRC in the realms of having an agent account, and we don't do payroll, we don't do compliance. It's all advisory. We still write to HMRC. We write clearances every day.
One of the phrases is preparing documents on which HMRC rely.
Well, they're going to rely on a clearance application, so clearly we do.
So
but there's nothing. We don't need a gateway for anything.
No, so I think not wanting, but give you guys a few months' notice. I think you're pretty likely to have to register. And there could be other similar businesses that are caught. I
was going to say, is there anyone who's in the advisory world who's not doing compliance and already have those kinds of links?
Whereas, and actually, you're a great example because Jerem's Miller will almost certainly have to register. I think the question is, will Jerem's need to do it? Now, Jerem's will certainly have an agent services account. But I wouldn't think HMRC would have visibility of who is who's going to be classed as a senior manager or their tax.
Yes, I mean, if you look at just an account an accountancy practice of a reasonable size that does audits, accounts, personal tax, both compliance and advisory, payroll. That's a very standard kind of accountancy firm, even with just a few employees. So, does the audit partner have to be involved in that? He or she isn't doing any tax. So
the current definition is it doesn't matter whether they're working in tax. It's if they're held out as a owner, effectively, corporate or otherwise. The firm, so the tax advisor appears to be the firm. That tax advisor has to bring all of them into this eligibility criteria.
Which for bigger firms it's a big task. Especially if you're going to say you've got to do this within 6 months.
There's going to have to be some wiggle room here, isn't there? Because,
there has to be.
The big firms cannot have one partner doing something that derails that firm's ability to engage with HMRC.
It makes me think of things like, if you want to be registered with the CIOT, I think it's either more than 50% or more than 75% have to be CIOT members. So there is wriggle room there, because you could say, as we have in our case, one of ours is an ACCA member instead of CIOT, and everyone else is CIOT, so we can still be registered with CIOT. So you would think that would be a logical thing to say, at least 70. Maybe you do have a high threshold for that.
Or it could be a period of time to get their tax affairs back in order, so that we haven't got tax affairs outstanding for more than 3 years or something. But even that, some tax cases can drag on, can't they? So
absolutely,
it does need a lot of clarification and thought. And again, April 26th, but don't worry, you've got a 3-month transition period. So I think that's a big thing coming out of legislation day, definitely. And then alongside that, there's draft legislation to change the regime around tax advisors and dishonest conduct, as it's called at the moment, and to cast that net wider, so it will catch cases where a tax agent does something that does deliberate action that has scope to reduce the tax take of that client. And the example given in the tax information note is filing a return that agent knows to contain an inaccuracy. Now, that is not allowed anyway for firms registered under professional conduct in relation to taxation, in that, we simply mustn't do it. It's not ethical. The point, so again, it's different rules, different language, but they're coming back to the same point. So ethically, a PCRT subscribing firm can't do it. The point that HMRC, I think, are trying to make is that dishonest conduct means that agent has actually been involved, been doing something dishonest.
Right.
This taking deliberate action to reduce tax, that could be we're filing a return that we know to contain an inaccuracy, but we haven't created that inaccuracy ourselves. So it's giving the revenue a wider avenue to come after tax agents for their behaviour. It will give them easier routes to access agent records, and the penalties associated with this are significant, let's say.
Which I can understand that. You don't want someone who's actually there assisting. You basically got someone assisting clients to be dishonest in a sense. So it doesn't surprise me that you'd have significant penalties on that. I think
the principle is fine. What I often see, often's probably unfair, but what you can see is due to busyness, due to work pressure, due to inadequate training of the person that's doing the work or doing the sign-off, is mistakes happen. They do. Not because anybody is trying to reduce tax or even evade tax, but silly decisions do get made and returns do get filed. And then 99.999% of times, if the firm becomes aware of that, that return is then sorted, amended. So it does get corrected. So I think it's another important piece of legislation to keep an eye on. Okay,
so obviously agent behaviour is under the spotlight. I think for me, the biggest thing out of those last 10 minutes or however long we've been talking about this is the registrations and what's going to be needed there. Hopefully most of the people listening, the last bit is less relevant. There is no deliberate behaviour in filing incorrect returns and things, but as you say, mistakes happen. So I think we're pretty much at our hour. There was only one other thing which was worth a mention, which there is some new information or new draft legislation in relation to umbrella companies. So worth looking at that if you have any involvement there. But otherwise, it just remains me to thank you for joining me again. And I hope you'll come back again because I do like these chats. And
thank you.
Go through these things.
I like having these chats too. Thank you for having me.
Thanks to Sharon for joining us. And thank you, everybody, for listening. If you found it useful, don't forget to like, subscribe, and all of that fun stuff on Spotify and YouTube. And hopefully we'll see you again on the next one. Thank you.